put that in perspective, you'll see some production numbers here in a little bit. They're currently forecasting a global critical rare earth element shortage. The last bullet, we talk about the lack of replacement, recycling, or reinvention. There are already very clever people looking at how can they make electric motors more efficient. And I will tell you one thing, an electric motor needs a magnet, full stop. There will be some recycling, but if you can imagine the size of the magnets in your cell phones and that sort of thing, that recycling industry is going to be probably very expensive. The rare earth elements have been used for years and years and years. And, you know, you might not be familiar, but phosphors in your TV and cell phone and computer screens, ceramics and glass, paint, and metal alloys. But I would highlight, and we're all talking about it, I would highlight the fact that the focus on the rare earth elements is going to be in the magnet industry. You can see the chart on the right-hand side of the screen here, the neodymium oxide price. I think we all know that global pricing is opaque, in part and parcel because of the control of the Chinese in the marketplace. But you can find rare earth oxides pricing online, and you can see here that historical prices have gone up by 100 to 300% since 2017, although they were mostly flat until mid-year last year. 2019, the USGS says that roughly 220 tons of rare earth oxides were produced. I think that was up about maybe 10% last year, but we haven't seen final numbers. But the point is that the demand and the pricing go hand in hand here. We know, or let me rephrase that. I think we can conclude that this time it actually is different. I reflect on, you know, how many times have we as investors heard that comment? Excuse me. How many times have we heard that comment? This time it is different. I reflect on the dot-bomb era of the early 2000s. But this time it is different. We saw the boom bust about 10 years ago. And there is a massive move, as the previous speaker had mentioned, to move the rare earth supply chain out of the Chinese sphere of influence. There are many risks to having a critical supply chain dominated by one company. I won't say that the Chinese are enemies, but they certainly could be deemed to be not friends at some point in time. And the U.S. has recognized that and taking the first steps to develop their own rare earth supply chain. And when you consider the strategic elements of the strategic nature of the rare earth elements, think about things like there's 417 kilograms of rare earth metals in an F-35 stealth fighter jet. The Americans need to control that supply source. So the Critical Materials Defense Act has been put into place in the U.S. We've got an MOU signed between the U.S. and Canada to cooperate on the development of the rare earths, and Canadian government has also released their critical rare earth elements. We all know about the moves in the U.S. to move or to attempt to jumpstart potential heavy rare earth element production within the U.S. And I think you guys will find the lunch speaker to be very insightful on that topic. And, you know, Canada and the U.S. are literally just divided by a border line. It's an excellent opportunity for development of a rare earth project in Canada. We're right next door. So I'll talk a little bit about our assets, and then we'll go into some of the program here. We're in northern Saskatchewan. This is a very busy map, but I want to highlight a couple of things. First of all, this is the Athabasca Basin. Our Alces Lake project is at the northern edge of the map, just about 35 kilometers east of Uranium City. You can see a couple of provincial highways on here that get to within about 100 kilometers of our property. But the good news is that notwithstanding it's in northern Saskatchewan where it's still winter, the access routes are well established. I think we've just hauled in our last loads for the summertime across the ice road. There is a barge service that runs in the summer across the lake. There are airstrips. Uranium City has excess power. And you can see on some of these maps, or on this map, some of the symbols for old or existing uranium mines. And we also have some uranium assets on the eastern side of the basin, but we won't talk too much about that just yet. Drilling into our assets, we're going to highlight the Alces Lake project. The inset map at the top of this screen, highlighted by the big yellow arrow, is a small box. That's what this larger map is down below. And within the larger map down below, you can see a diagonal rounded rectangle, which is highlighting where most of our rare earth exploration activity has been undertaken. And we're going to start drilling into that. But first of all, let's talk about Alces Lake. And I think I can surmise it in one word, and that is monazite. And summarizing it in just another word, massive monazite exposed at surface. And you're going to see some pictures through here. There's a picture at the bottom of this slide that shows a high-grade monazite at surface in the Wilson zone. And you'll see some of those zones here in further pictures and maps. But when you look at a massive monazite exposed at surface and a monazite deposit such as Alces Lake, you need to consider a number of things, and that includes grade, mineralogy, composition, and location. And we've talked a little bit. We've mentioned the rare earth total weight percent, which is phenomenal. The mineralogy is completely hosted in coarse grain monazite, and I think many people know that monazite has been mined for years and years and years, so it's a very well-established process flow. The good news is that the composition of our monazite is roughly 23 to 25% critical rare earth oxide, and those include those rare earth oxide magnet materials. And then lastly, as we mentioned before, it's located in Saskatchewan, and Saskatchewan is one of the best mining jurisdictions in Canada, but it also has a couple of other things going for it, and that is it is in the same area that the Saskatchewan Research Council is located. They're very well respected globally. They're very well experienced in radioactive materials. And we're going to talk about the processing facility that they have under construction. So first of all, this is what it looks like on surface, massive monazite. You can see both on the pictures on the left and the right, more than 85% monazite, and the Dillon zone more than 57% monazite. This is its surface. And we've got more pictures here, but all through the area of exploration, we see monazite at surface, and that's very important because that becomes part of the story here. Talking about grade, so we've taken data from all of the publicly announced rare earth deposits around the world, and we've created this graph, and you can see that next to the Gakara deposit, Alces Lake looks to be potentially the second highest average grade of rare earths in the world. Using a 4% weight percent total rare earth cutoff, Alces Lake averaged 16.65 weight percent of total rare earths. Now, you can see some of the other global projects on here. I won't delve into them in great depth, but suffice it to say that we've got a very significant deposit here, and we're moving forward to get that better understood. The mineralogy, I've talked about it a little bit, but monazite. Our rare earth elements are 100% hosted within the monazite, as is the gallium that we've also found to be within the monazite. And again, rare earths are, the extraction process for rare earths from monazite has been around since the 50s. Typically, monazite at Alces Lake will occur in isolated grains. They're 1 to 3 centimeter lenses. And as you can see from another picture here on the right, the Dillon zone, another massive monazite at surface. And the beauty of that is that if you could find, I hesitate to call it a vein, if you could find a continuous source of these, that would make the extraction of the rare earth monazite very straightforward. Talking again, just repeating myself a little bit, but the composition is, as we highlighted in a previous slide, almost 0.25% of the total rare earth elements are the critical rare earths. And the interesting thing here is that this is the most valuable part of the rare earth magnet chain. It represents about 85% of the potential value at Alces Lake. And interestingly enough, we have a near perfect correlation, better than a 0.98 R squared, between the total rare earths and the critical rare earths, in that the higher total rare earth grades that we find will mean a higher, excuse me, critical rare earth grade within the monazite. The beauty of the Alces Lake project being in Saskatchewan is the Saskatchewan Research Council is in Saskatoon. They're roughly 1,200 kilometers away from our asset. As I mentioned before, they're very well known and understood globally in terms of their capabilities, and they're also licensed to handle radioactivity. The interesting thing about monazite is it's always associated with uranium and thorium, and that becomes a problem for processing of rare earths unless you have a radioactive license. Now, the government of Saskatchewan announced, the Saskatchewan Research Council announced last year that the government is supporting them in the funding of building a first of its kind in Canada rare earth processing facility in Saskatoon. The Saskatchewan Research Council has global experts in rare earth. They've also had the pictures down below show a pilot processing plant, has a 2,000 ton per year capacity. They've already run that for an optimization of a monazite processing flow sheet. They're building a 3,000 ton per year processing facility, which is expected to be on stream sometime in late 2022. In terms of the Alces Lake project, we're going to talk about this in a little bit more detail here. This is not Alces Lake. This is a representative picture, but our deposits thus far is so close to surface that potentially, at least initially, we might be able to go in and quarry the monazite as opposed to having the higher expenses of developing an open pit mine. It is our goal to maintain a very small environmental footprint throughout the area. We also have a goal of establishing industry-leading environmental, social, and governance programs. So just want to get into a little bit here. Exploration, mentioned before, we've discovered 74 zones on surface. We've drilled diamond drilling. You can see the numbers here, just under 5,000 meters. 2,500 meters of that was last year, 95% success rate. And the high-grade WRCB zone, we're going to show you here in a second, is within 10 meters of surface, and as you've seen from some of the pictures, on surface. It's a large block with less than 1% of the block being explored by diamond drilling. This is an aerial picture of the WRCB zone. You can see here total rare earth oxide percentages, and this is looking southwest. I'm going to show you, excuse me, I'm going to show you the next map, which nobody has seen before, but it gives you an idea of the significance of our deposit. This is straight out of the geologic software. I'm going to show you a couple of cross sections. One is a cross section from A to A prime, which goes from Charles to Dante. and the long section going from Charles to Wilson. This is based on actual drill data that we plotted in Leapfrog. The vertical and horizontal scales here are the same, and the significance is of this that you can see that the deposits are literally within 10 meters of surface, plus or minus. You can also see all the drilling traces on this slide, and some highlights in terms of total rare earth weight percent, and I'll show you a core from the Ivan well here in just a second. That's a cross section. This is the long section, and you can see here that the long section shows, again, very significant, significantly developed total rare earth deposit, and this is the long section. Now, we don't have a lot of drilling in between, but if you were to go back to the previous map, it begs the question, well, we've got two lines that show it in two directions. What about in between? And that's where it could get very interesting. I won't zoom in on this too much, except to focus on the 3.7 meters of total rare earth at 49%. This is from that Ivan well. You can see that looks like probably one of those big exposures of monazite. Getting into some geologics here, I won't get too deep into it, but I'd just like to make a couple of highlight comments. First of all, with the diamond drilling that we've done, we've extended the strike length of our rare earth area over 875 meters. We have found rare earths as deep as 340 meters, but we've been drilling shallow holes and finding the rare earths sort of 10 to 20 meters below surface. The interesting thing is we haven't found the full extent of this. It's open in all directions. And we have at the WRCB zone extended the high-grade rare earth element deposit over 145 meters. And this map just shows you some of the exploration sampling that we did last year. You can see very sparsely explored block. Our WRCB zone is that pink star that's just under the Irmakre label on the map, but there's lots and lots more work to be done. So just getting into 2021, we've got a very active program, but ahead of the program, you may have seen some of our press releases. We're bench scale metallurgical testing at the Saskatchewan Research Council with the WRCB. And I won't read the slide, but it's going to be a very important metallurgical testing program. We are reanalyzing our geophysical data. And then as far as the summer goes, a property-wide airborne mag, EM, and radiometric survey along with ground radiometry and ground geophysics. We have a plan to drill at least 5,000 meters this summer. And because we're going to have now a winterized camp, we will be able to work through the winter, and we could potentially get into some uranium exploration, although we are focused on the rare earths at this point in time. I might add that we are fully funded for our drilling program this summer. We're estimating somewhere between $4 and $5 million total capital expenditure, of which we currently have $6 million, looking at possibly $1 million of additional warrant exercises coming in. So let's look at just a quick summary here. I want to leave a few minutes for questions. And that is, so we heard the keynote speaker talk to us about the global rare earths. We are going to be a part of that. You know, the title slide said a technology metals company. Think of us as that, as the resource supply. There is a global move towards cutting the Chinese dominance of the global rare earths industry. I personally think it's 5 years plus to get that supply chain sorted, but in that interim period, there's a lot going on, and we're going to be a part of it. The fact that we're in Canada, we're in Saskatchewan, where the SRC has a processing facility. We're roughly 1,200 kilometers from that facility, although there will be some ice road and lake crossing and provincial highways to get it there, but we're within a few days of transporting our materials to Saskatoon for processing. The Alsace Lake project is a world-class total and critical rare earth deposit. People will tell you they've never seen a rare earth deposit of this quality. And it's 100% monazite. It's roughly 25% critical rare earths, the magnets plus gallium. And, you know, as I said before, the monazite is very easy to process. Mineralization is at or near surface. You've seen some of the pictures of the monazite massive lenses that are there. And we've got a rare earth system here that we haven't defined the limits of it. So with that, I will just highlight the very last slide here, and this presentation is available on our website now. Some of the detailed data. I will now go into some of the questions here. So question number one, I mentioned, yes, we're roughly 1,200 kilometers from Saskatoon. Is there any government support for the exploration of rare earth elements? Well, we are in a very, Saskatchewan is a very mining-friendly jurisdiction. So we have lots of positive things to say about mining in Saskatchewan through the government. If you're familiar with Canadian tax law, there are also there are tax advantages for doing flow-through shares. Let me see here. Sorry. Thomas, would the processing facility be considered to be a commercial size at 2,000 tons per annum? At what point in time could they increase commercial scale? Well, the SRC has a pilot plant at 2,000 tons per annum. They're currently building a facility at 3,000 tons per annum. That is a commercial facility. And if you've been following what's going on in the U.S. at the White Mesa mill, they're going to be processing 2,500 tons per annum of monazite for rare earth elements. That I can't really comment on that. Let's see. I'm just mindful of my time here. Internal supply chain. How will that affect us? Well, we're positive to the support of the Canadian government, also recognizing the critical rare earth element supply chain and the fact that they've signed an MOU with the U.S. Let's see here. So I think how far I answered that question. Operations similar to Nechalatka Lake. At this point in time, we do see that, as I mentioned, lots more work to be done yet. We can't determine exactly what our extraction process will be, but at this point in time, it does look like it could be a quarrying operation, at least from the get-go. That's the end of my time. Thank you very much for your attention, and appreciate speaking with all of you. Bye for now.
Please submit your questions in the question box to the bottom left of the slides. Once the Q&A session is ended, don't log out. You'll automatically be transferred into the Osisko booth, where you can continue to ask questions via chat and access additional shareholder materials. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Bob Wares, Chairman and CEO of Osisko Metals, which trades on the OTCQX Best Market under the symbol OMZNF, and on the TSX-V under the symbol OM. Welcome, Bob.
Yes, good morning, and thank you very much for the introduction. So today we'll be discussing Pine Point, which is one of the, as far as we're concerned, one of Canada's leading lead zinc projects located in the Northwest Territories. Before I start discussing the point, forward-looking statements, standard statements, I'll summarize the takeaways from this presentation, essentially including our view on base metals. So, in our view, decades-long divestment from the resource sector, specifically base metals, has led to global base metal reserve depletion, as we're on the cusp of a conversion or a shift towards green, sustainable economy. Coupled to post-COVID infrastructure stimulus, we believe this will dramatically increase global base metal demand, and hence we believe we're on the cusp of a long-term bull market in base metals, specifically affecting copper, zinc, nickel, cobalt, and aluminum. Zinc specifically is particularly exposed to medium-term supply deficits. As miners, we look at the supply side more than the demand, and we are headed what we believe is an inevitable supply deficit in the zinc space in the next 3 years, which is going to particularly affect North America, which is why we believe our company now is very well positioned to develop one of the best zinc-lead projects in North America. A milestone last year in 2020, Point, we issued a PEA, which is preliminary economic assessment, of course, based on $1.15 US a pound zinc, which was a conservative number. In our view, this resulted in an NPV of 8% of Canadian $500 million, NIR 29.6, both after tax. So these are very encouraging numbers, and has encouraged us and convinced us to carry on developing this project. This was based on a capex of 555 million Canadian. With the actual mine plan we have in the PEA, this would result in a 2.8-year payback. And one of the key points of Point, which makes it exceptional even on a global scale, is the quality of the zinc concentrate that we have the potential to produce. Before going into the details of Point, I'd like to make a few statements regarding our view of the current situation in the base metal space, in the markets, and where we're headed. What you're seeing now is a relative CAPE ratio. CAPE stands for cyclically adjusted price earning ratios. So what you're seeing over, and this is a 100-year chart, almost from 1925 to the present, it's showing the average price earning ratios of base metal companies on the S&P 500 relative to the ratio, the average PE ratios of companies on the index. So if a particular sector is receiving as much market attention as the overall index, you would of course expect that ratio to be 1. The 100-year average is just below 1, which is normal. However, right now we are actually at a 100-year low, which means that markets in general have never been so divested away from the base metal commodity sector in the last 100 years, which is quite striking. And of course, the reason for that, when you consider today we're below the dot-com boom of 99-2000 and even below the crash of 29-30, it simply means that the funds and capital inflow has been into other sectors, Bitcoin, pot, new tech, etc., and has moved away from commodities. Looking from the situation from that 2015 low, this is another parameter, which is on the Canadian side, the TSX S&P Global Base Metal Index as a proportion of the overall composite index, and you see exactly the same thing. We hit this 100-year low in 2015. Starting from in 2015 and heading towards the end of 2017, we had started a recovery. And then the U.S.-China trade wars and the pandemic ensued. And last March, exactly a year ago, we were back to that 100-year cyclical low. So once again, since last March, we've been on the road to recovery. And now we believe, given infrastructure stimulus coming through the Biden administration and shift towards greener economy, this is going to put a lot of pressure on base metals, a lot of demand, and that's why we believe, barring any other global catastrophe, we're set the start of a long-term bull market in base metals in general. And to illustrate this point, on the demand side, this was published by Glencore about a month ago. Glencore is one of the largest traders and producers of base metals on the planet, especially on the trading side. They released this a month ago, basically illustrating what it's going to take if we want to decarbonize our economy and meet the 2050 goal of net zero emissions. So obviously reducing consumption of oil, coal, and gas. This is going to translate directly into incredible demand for base metals. Glencore anticipates in the next 30 years it would require doubling the global copper output, doubling the global zinc output, and astoundingly almost quadrupling the output for nickel and cobalt. And this is largely due, of course, to production of EVs and electrifying our renewable grid system. So these objectives are completely unrealistic. There's no way the global mining industry can meet this demand in the next 30 years. So the message is that it's going to take longer than 30 years to move away from our dependence on the fossil fuels, because the base metal industry simply will not meet that demand. So back to zinc and the use for zinc. So the major use for zinc is galvanization, rust proofing, anything from cars to infrastructure. So construction industry, infrastructure industry, and transport industry consume the lion's share. And obviously, this is absolutely essential if you want to think of sustainability. Nobody wants to see this. For those of you who are old enough, such as myself, to have had a car in the 70s, obviously it didn't take long for it rusted away. And nobody's going to want to drive EVs that rust away within 3 years. Much of our North American infrastructure is looking like this. This is a common site in North America. It was built in the 50s and 60s, largely because much of the steel and rebar was not galvanized. So with an infrastructure stimulus package and reconstruction across the continent, this is going to put tremendous pressure on the zinc supply, and we believe is going to increase demand substantially. A new venue, potential new market for zinc, if you want to think of green economy and renewable energy, is in the form of zinc hybrid flow batteries. This is relatively new technology, which I believe will be essential to make solar and wind energy cost effective. These technologies work great, but the issue is if you can't store the electricity and deploy it at peak demand into the grid, then they become far less cost efficient. So the solution to expanding solar and wind energy is through energy storage. One U.S. company called EOS System is now producing and marketing container size zinc hybrid flow batteries, and we believe this is the best solution for grid storage. It's cheaper than large-scale lithium-ion batteries, and it's probably safe to assume in the next 10, 20 years that pretty much all lithium supply globally will be absorbed by the transportation industry. So zinc battery storage is a fantastic alternative, low cost, and just as efficient. So this is an expanding market for zinc. And as I mentioned, as miners, we don't put as much emphasis on demand as we look at supply. This was produced by Teck last year at the PDAC in Toronto. It was essentially their own view on the outlook for zinc. And then keep in mind that Teck is the largest producer of zinc concentrate in North America, operating the Red Dog mine in Alaska. In a low demand scenario with only 1.2% long-term growth, Teck estimates that a permanent supply gap is going to develop in 2024, and we concur. No amount of greenfield development can make up for this deficit. If you look at more closely at the North American supply situation, and I think I just lost my screen. All right, sorry, this slide is coming up blank. I'm going to assume some of you can see it. It's essentially a production profile to in North American mines to 2024. We are looking at closures of mines over the next few years, including Kid Creek Mine in the Matagami camp in Canada. This is going to lead to a 35% drop in zinc production in North America in the next 4 years, which at this point is inevitable. So let's have a look at Pine Point. It's located here, just north of the Alberta border in the Northwest Territory. It is a past producer, so a brownfield development story. We acquired this 3 years ago. Cameco produced from Pine Point from 64 to 88, a total of 64 million tons over life of mine, 10% lead zinc. And this was all shallow open pits. So keep in mind that most global zinc operations are underground, and Pine Point was unique and would be unique again to the extent they would all be shallow open pit operations or very shallow underground operations. So it's located on the South Road Great Slave Lake, in road and rail access to the town of Hay River on the south side of the lake, and then paved road access to the original mine site. The site still includes foundation to the original mill, and importantly, a power substation that's fed by the Townsend Power Dam. So the infrastructure is largely in place, and when you're considering investment in base metal projects in general, it's very important. I can't emphasize the importance of looking at infrastructure. When you're building a gold mine or a diamond mine, you always have the option of winter roads and then flying out your doré bars or your suitcase full of diamonds during the winter time or year-round on a flight. In the case of base metals, you have no choice. The concentrates have to be barged out, railed out, or driven out, and so infrastructure is absolutely critical. And in the case of Pine Point, again, all the infrastructure is in place. It's one of the reasons why we acquired this project. In terms of exporting any potential concentrate out of Pine Point, it would be rail to Edmonton, Alberta, and then from Edmonton, we'd be on the main CN line that crosses the country, so we would access to West Coast and Asian markets or the Eastern Seaboard. In terms of our production costs, our PEA indicated a total production cost of 67 cents per pound US. Right now, I remind you, zinc is between 125 and 130 US a pound, so it's faring very well. And this chart shows production costs of all producers on the planet. This is data called from SNL and WoodMac databases. And Pine Point at 67 would be located here, which would put it potentially in the second cost global quartile, which is an excellent position to be in. These cost curves include mining, processing, TC and shipment costs from smelters, and of course royalties. And you'll notice the high end of the cost curve, many small producers now in the world, largely in China and Peru, have very high cost profiles, especially on the smelter charges. And 10% of the global production right now is actually sitting between at a total cost of 125 to 150. So again, pressure on production. Unless long-term zinc is sustained at about $1.50 US a pound, there's 10% of the global production that is constantly under risk. In terms of the result of our PEA, we modeled the production over a 10-year period of Pine Point. This is based on 39 million of our current 50 million ton resource. And this is the reason Pine Point would be a very significant producer globally. In fact, would have potential to become a top 10 global producer with a maximum peak in year 3 sitting at about 460 million pounds of zinc production. And I emphasize that there are resources to extend that mine life, but on an 8% discounted cash flow model. Many of you probably realize that anything that happens after 10 years is inconsequential. So the idea is to simply focus for now on the first 10 years of production. We've got another slide here. No, this slide is not coming through. Okay, I might have to refresh my browser. I'll give it another shot. Sorry, but no, my slides have stopped coming through. Stand by. Okay, I think we're going to need help from Janel here. One more time. Okay, thank you, Janelle. The webcast engineer just fixed the problem, so we are now currently on the slide 17, where we're seeing really what is the true beauty of Pine Point is in the quality of the concentrate. So on the left-hand side, you see the blue bars. This is comparing Pine Point composition, and I emphasize this is our own metallurgical work that did confirm historical Cominco production. But again, this is work that we verified ourselves. So comparing Pine Point to silica, iron, lead, and copper, and comparing Pine Point to Red Dog in Alaska, Rampura in India, Australian operations, and Antamina in Peru, you see that Pine Point is a far cleaner concentrate in terms of major elements. On the right-hand side, the ditto for trace elements, including arsenic, cadmium, mercury, and manganese. Pine Point is fantastically clean, no deleterious element. So for that reason, Pine Point would have the potential to produce a premium, high-grade, high-quality concentrate, which would be marketable globally. And at 59% zinc, it's also an extremely high-grade, rich concentrate. Most global concentrates run around 52% zinc. So in the next slide, it's just a quick wrap-up. We see that Pine Point has the potential to become a top 10 zinc producer with excellent PEA numbers, would have the potential to become or to produce an exceptional high-grade clean concentrate. And also the fact that we have infrastructure in place, very important again for any developing base metal situation. So I want to emphasize what we're going to do over the next year. So first point is that we do plan on producing a PEA next year, this time next year, 2022, which we believe will be an updated PEA, which we believe has the potential to considerably improve IRR and NPV. This is because we believe with additional metallurgical work, we can increase zinc recovery from 87 to 90. We'll carry on with an aggressive drill program this year to convert inferred resources to indicated, which would allow us to define reserves for an eventual feasibility study. More importantly is water testing. So when you acquire a brownfield site, there are always legacy issues, and one of the legacy issues is as a rumor, if you like, in the market that the Pine Point mine back in the 80s closed down because of water infiltration. This is simply not true, but it is a rumor which is impeding share price improvement. So we decided this year we're going to put this rumor to bed once and for all. As we speak, we are drilling water wells on site. We will carry on this summer with pumping tests and tracer tests, be able to quantify water flow into the Pine Point mineralized horizon. And this will allow us to considerably, we believe, reduce water management costs over life of mine. In the current PEA, for lack of data, essentially the engineers modeled pretty much worst case water infiltration scenario, which resulted in a $370 million life of mine water management cost built into the PEA, including $50 million into the CapEx. So by quantifying water flow in the system, which we'll do this year, and we expect the report to be available Q3 this year, this will lead to, we believe, considerably less reduced water management costs in next year's updated PEA. So next slide, essentially back to the site itself. So on the left-hand side, you see the west zone. If there are any water issues, and again, we do not believe this is a red flag, we will, if there is any water infiltration, it will be limited to that sector. And this is the portion of the camp that holds the richest deposits, as you may have seen from press release 3 weeks ago and this morning's press release. So we're currently doing infill drilling on the west zone deposits, including the R190. Results to date are very encouraging. We'll carry on with this program throughout the year as part of our infill program for the entire camp. I want to take the opportunity at this point to point out that the camp and our land position stretches over about 45 miles. So it is a very large mineralized structure, and it still holds a lot of potential for new discoveries. And in the next slide, we show the simple geology. We're looking at flat-lying sediments. Most of the mineralization is in the Sulphur Point Formation, and that's where our resource is essentially all centered. You have high-grade prismatic zones, which are vertical pipes, and connected by tabular zones, which hold potential for resource expansion. So our current resource right now sits at about a total of 50 million tons of mineralization, divided or spread between indicated and inferred. The bulk is still in the inferred category, and that is what is going to be converted to indicated as we continue drilling the properties. And there is a lot of potential. This is an example from the M39 for resource expansion. You'll notice north of this deposit, there's essentially no drilling. So that's one example amongst the 47 deposits on the property for which we believe we can significantly expand the tabular zones. And next slide is essentially the results from R190 announced 3 weeks ago. Exceptional results, 27 meters at 42% lead zinc. This was in the center of the prismatic deposit. And a simple example of how our infill program is producing positive results, which will lead eventually to incorporation into our next resource statement. I want to emphasize the core of this deposit cut 7 meters, about 23 feet of astounding grades, about 56% lead zinc. These are highest grades personally I've ever seen in the course of my career at any rate. Okay, so we're running a bit short on time for Q&A, so I'll skip right to the conclusions. In terms of quick wrap-up, So essentially, we believe, once again, we're sitting in terms of ratios to the overall indices, we're sitting at 100 of relative lows in the base metal space. We believe we're on the cusp of a turnaround and the start of a long-term bull market in base metals. Zinc is particularly sensitive to the supply that's entering, so we believe this is going to have a very strong impact on spot price, and that the timing is actually ideal right now to be developing zinc projects. Pine Point has the potential to become one of the leading zinc projects and mines in North America. So any investor who wants exposure to zinc, we should seriously consider Pine Point and Osisko Metals. And then the shorter term, right now, going into 2021 this year, you'll see a lot of drilling, an emphasis on water management to better quantify water flow and water management costs in the next PEA, and continue our program to convert inferred resources to indicated. So that's it for the presentation. We have a few questions. I'll have to start question number one, any First Nations issues? Essentially, no, we've got agreements with all First Nation groups right now on site, and including the Northwest Territory Métis Association. So we will proceed with IBAs. We've agreed with First Nations to sign IBAs before we go into productions. Another question, plans for financing CapEx. It's basically going to be fairly standard, a combination of debt and offtake agreements. Again, the next PEA, I'm confident we can bring that CapEx down to below 500 million Canadian. We have a lot of interest in the project right now for future financing, so we do not believe that is a concern. We will try to avoid any further or any equity financing on the mine bill, because that would be too dilutive. In terms of another question concerning our timeline right now to get production ready, or shovel ready, as we say in the business. Right now we're looking about 3 years to the end of 2024, with a total cost of about 75 million Canadian. That would include drilling, complete drilling program to convert everything to indicated resources, full feasibility study, permitting, and IBAs with First Nations. So basically a 4-year timeline. Please discuss ownership of shares. Let's see if I can get that slide up. It's last slide in the appendix. Again, hang on a sec. No, I overshot it. Excuse me, I'll see if I can get that in there. Here we go. So for those of you who see it right now, we have about 179 million shares outstanding. Closing price around sitting right now on 45 cents. Osisko Group as a whole owns 22%. Management insiders 19. 2 funds here in Quebec own 6. So essentially 47.7% control on the outstanding shares. Fully diluted, we're sitting right now at 202 million. So I think we've run out of time for the presentation. Thank you very much. Any additional questions can be accessed through the platform or directly to Osisko Metals. Myself or Kel will be in charge. Thank you very much for your attention.
And access additional shareholder materials. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Alex Sukernick, President and CEO of Nova Royalty Corp, which trades on the OTCQB venture market under the symbol NOVRF and on the TSX-V under the symbol NOVR. Welcome, Alex.
Thank you very much for having me. It's a pleasure to be here on a beautiful Tuesday morning in New York. We're a relatively new company. We've been around for about 2.5 years. We've only been public since October, but it's great to see the reception from the investors so far. When you're an entrepreneur, you put a company together, it makes sense to you. It's really fun when it begins to make sense to everyone else. So let me just sort of start and kind of walk you through what we've done so far and why we're here. And hopefully all of you who are listening would like to find out more about us as time goes on. So this is just a forward-looking statement. That's all up to the lawyers. When you look at what's happening right now in the world, what is occurring is not an economic change. What's occurring is a fundamental change in sensibilities and values. And when we put NOVA together in 2018, that's really what drove all of our thinking. So foremost, what we saw was that, what we refer to as the energy transition, it was really, I think at some point the world got to a place where it didn't want to live in the old paradigm, and I think fossil fuels were definitely part of the old paradigm. And so everything you're seeing right now with the transition to green energy, electric energy, whatever words people use, this is, I think, probably the most powerful movement that we're going to see in our lifetimes. And what we saw occurring in this movement was that oil and coal, which were really the primary drivers of the carbon age, were going to exit stage left, and copper and nickel, which are really the core building blocks of the electric age, were going to become the new tools which the world would use to power itself. And what we thought about was we wanted to put together a company that would be a mainstream participant in everything that was occurring. And what we loved the most was the royalty model. Because a royalty, if any of you are familiar, it gives you exposure for life of the deposit to the revenues of the property. And what we found sort of from prior experience, and really the royalty model in mining before, has really been used in gold and silver predominantly. The royalty companies have really captured the imagination of the investment community because they provide investors with all the commodity price exposure, none of the costs, and it's just a much simpler way to own exposure to a specific commodity than necessarily an individual miner. You can get a diversified portfolio of many more assets than you could ever have an operating miner. After all, it's much easier to add a royalty to the portfolio to diversify than it is to build a new mine with a fraction of the operating cost, because all you need to run a royalty company is staff. So you can have a multi-billion-dollar company operated by a relatively handful of people. And because we were really the first to focus on the copper and nickel sectors, as a first mover, we had a chance to buy royalties on really some of the world's most important systemic assets. Now, the key differentiation for what we've done is we haven't transacted with the miners themselves, because if you want to go and buy a royalty on a top-notch deposit from a Teck or a Newmont or a First Quantum or a Rio Tinto, your chances are really non-existent, because these are large, strong companies who will never sell royalties on their assets directly. However, most of their top assets at some point have had a royalty on them, because they will typically, unless they discovered it themselves, typically they will acquire an asset at an early stage from geologists or a family that may have had the asset at some point. And usually in the course of those transactions, there's a royalty originated as part of the purchase price. So the major miner will buy an asset for some combination of cash, perhaps shares, and also leave a royalty. So for us, when we put the company together in 2018, and we literally mapped out the whole world of copper and nickel everywhere, then we really focused on finding the royalty owners around the world who sold assets to the major companies before, assets that have since moved on to the sort of at the forefront of their pipelines in preparation for the energy transition. So if you look at what we've done, we've acquired royalties from the original asset owners who got royalties as a part of the transacting with the major miners on some of the world's best mines, and that's Taca Taca, which is First Quantum Minerals in Argentina, one of the world's largest copper development projects. And First Quantum has been pretty clear about the fact that this is their next major mine. Nueva Union, which is also one of the largest copper development projects in the world, and that's a JV between Teck Resources and Newmont Mining. The Dumont project in Quebec, which is the world's second largest nickel reserve, fully permitted in Quebec, and we really think that's going to be the core of the North American nickel supply chain that's going to emerge as part of the EV space. The Twin Metals project in Minnesota, which is really, when you look at the United States, this is by far the largest copper and nickel camp in the United States. It comprises about 34% of all U.S. copper reserves, 95% of all U.S. nickel reserves. And the Vizcachitas project in Chile, also one of the largest copper development projects in the Americas, over 2 billion tons of resources and growing. So this has given us, we think, an excellent foundation. As the world transitions, we're a royalty company with very few costs, life of mine royalties on really some of the world's most important development projects. And we're really excited here, just given where the world is going, the macroeconomic environment in copper and nickel, which I'll touch on a bit later, and the like. The team, look, I could talk about the team for a lot longer than I have time for, but that's really been the core of what's made it possible. We started out, really with a global team spread out across the world. When you look at the management team, the board, the technical advisors, it gives us incredible bench strength throughout. So when you look at the technical team, for instance, these are some of the most experienced chief operating officers and top-notch geologists in the world who have a wealth of knowledge and contacts. And so when you look at the underwriting process that we have, which is very intense and comprehensive, we've underwritten pretty much all the major assets in all the major camps in the world. It's really been the team that's allowed us to do that, and the fact that we've been able to grow quite quickly, since 2020, it's a testament really to the fact that we have done so much preparation and have access to so many strong people throughout. My co-founder in the company is Brett Heath, who is the non-executive chairman. Really a wonderful business partner to have. Brett started a very successful royalty company in gold and silver called Metalla Royalty and Streaming, which he grew from a small base of a $5-10 million company in 2016 to a New York Stock Exchange listed company today, market cap of over $400 million. And the third-party royalty model, where just as Nova uses the same model where we acquire existing royalties on top-notch assets, Metalla really, I think, pioneered the focus of that, and they became very successful. So when Brett and I put Nova together in 2018, we basically use the same model, but as a first mover in the copper nickel space versus the gold silver space. The capital structure for the company, look, we've had great investor support. BD Capital, which is one of the largest institutional investors in Canada, came in to back us right before we went public in October 2020. We had excellent support earlier on, when we just raised our first money from Adrian Day and Doug Casey and Stevenson Asset Management. So really, we've been very well supported by investors throughout. The balance sheet is very strong. The three financing rounds we've done have been done at 25 cents, 50 cents, to $1.45. So everyone who's invested in Nova so far, I think, has done exceptionally well, and it's great to see that. I'm going to touch on the macro stuff here because I think that, this is not something that people really talk about enough, even though there's more than enough narrative in the public market. Copper is fundamentally the successor to oil, given what's happening in the world. And so, while it's always been a large market, I don't think people fully appreciate just how important copper is. And so, previously, there hasn't really been a copper royalty company that was really well supported by the market. And I think the reason was that it was an important metal, but not a strategic metal. Right now, copper, given that, every time you have an electric car, you don't have an internal combustion engine car. Every time you have a wind farm or a solar panel, you're not burning coal to generate power. So really, when you look at the commodity substitution mix, you see copper going from already a huge position as the world's largest industrial metal to, I think, very much going to the world's core commodity, and that's what really spurred us to focus on the commodity so much. When you look at the supply situation, this is, I think, the part that really has the whole world scratching their heads at the moment. The supply has grown rather anemically, 1-2% a year, and every major transformation that people are talking about, whether that's electric cars, whether that's wind power, whether that's solar power, everything is extraordinarily copper intensive. So what you've seen recently is Trafigura, which is one of the world's largest commodity traders. They came out with a forecast recently saying that you're going to have a 10 million ton a year deficit in copper by 2030. That sounds like it's far away, but in an industry where it takes 7-8 years at least to develop a mine once you have a full reserve, that's basically tomorrow. So I don't think anybody right now even knows what the break-even price is, what the incentive price is for copper to meet that demand. For example, this is a market where you have about 25-30 million tons a year of total production, depending on how you count. And if you're talking about a 10 million ton a year deficit by 2030, just for perspective, Taka Taka, which is our largest project and truly one of the world's major copper development projects, that will produce just a shade over 200,000 tons a year of copper once it's up and going by the mid-2020s. So that's 2% of your 10 million ton deficit, and the good question is where the other 98% is going to come from. So, our thinking when we put NOVA together was that we could see that things were going in that direction, and we wanted to get the royalties in the largest, most expandable, most important deposits that would be required to drive that whole transition. And that's exactly what we've done. But the copper supply demand, I've spent over 15 years in the resource space, really the vast majority of my career. I've never seen anything like this. I remember the iron ore boom in the 2000s, and I think iron ore went up some 9 to 10x. But that was driven really by one end market. That was the Chinese steel industry, which really drove the whole thing. Right now, you have literally the whole world embarking on this industrial revolution, and everyone is looking to do the same thing, and it's, I think it's just, it makes the 2000s look like nothing. So, it's exciting to be here, with a company that's really well positioned to participate in everything. And then, of course, nickel. When you look at nickel, previously it was it was really a product for the stainless steel space. But if you look at what's happening with the battery technologies, really the two or three most common battery types at this point are nickel heavy, and that's clearly where the automakers' attention is going. So say 80%. And so when you look at the amounts of nickel they're going to be required, it's really going through a very systemic change in terms of the overall market. And so when you look at EV-related nickel demand, which is a chart on the left, you see it going up about 20x by 2030. But even more compellingly, when you look at on the chart on the right, which is the EVs as a percentage of the total vehicle sales, you're talking about a change from 10% to 58%, which basically is the difference between being a small part of the market to being the controlling part of the market. So when you look and see where EVs are going as a percentage of all vehicles, and you see the role that nickel plays in the battery, I think it really is emerging as a strategically important commodity in the global order. And so when we started NOVA, it was really based on a simple idea. We saw that the world needed a copper nickel royalty company, given how important these markets are going to be strategically. There were already large markets, as you can see by the total commodity market sizes. Basically gold and silver was about 200, copper and nickel about 170. I think given what's happening in prices, I'm guessing it could be bigger than gold and silver at this point. But really nobody focused on them because they weren't strategic. In the gold royalty space, investors, and I'll touch on that in the next slide, investors have clearly voted that they want to own the commodity for the royalty companies. Copper and nickel are only now emerging as strategic, so we felt that it made sense to put together the first focused copper and nickel royalty company. And when you look at this slide, I think it's really interesting. When you look at the valuation multiples that the gold royalty companies command relative to the producers, it's one thing to see the senior gold royalty guys traded around 3 times that of the producers. But even more compellingly, when you look in the chart on the right and you see what the junior gold royalty companies trade at, which is just over 22 times, that's more than double the multiple that the senior gold producers trade at. So what the market is clearly saying is that they would rather own assets that are not as strong, but in the royalty model, and they'll pay a premium for that. And I think what it tells you is that the royalty model is just a better way to own a commodity because you have fewer revenue exposure, you have very low SG&A cost of a royalty company. It costs right now maybe $1.5–2 million a year Canadian to run NOVA, which is not much when you consider the asset sizes. And obviously, it's not something that really compares to what a mining company has to go through. So, I mean, all of our royalties will have billions and billions invested into them by the miners, and we're fortunate enough to collect the pure revenues for life of mine. And so the market's pretty clearly said that they want to own their commodities to the royalties, and we felt that again, the time was really right to create the first copper nickel player out there. This is really a summary of our assets. I don't know how technical the audience here is, and so I don't want to get too far into it. I think the key really, when you look at the operators and you look at the sizes, these are all systemically important assets. When you look at any pipeline of copper or nickel projects out there, these are all the clear standouts. Taca Taca, we were fortunate after we bought the royalty in November that a couple days after First Quantum came out with a maiden reserve and announced plans to have a production decision in 2023-24. And when you look at the pipelines of the major companies, this asset stands out very clearly because oftentimes major companies will have one new asset in the pipeline. Most of the attention is spent on extending existing assets. I mean, the reason for that is copper assets are, these are often mines that go for a century or longer. When you look at the copper industry today, there's still quite a few assets that were built in the 19th century, not the 20th, 19th. So when you buy a royalty on something that's large and really a priority for a big company, you're getting something that will be a generational asset. And they think about these things very thoroughly because, it's not like a gold mine where you can have a 10 to 15-year life. I mean, for a big company to build a copper mine, that's a 50, 70-year commitment. So they think about it much more thoroughly than you have to on the precious metal side of things. And then Nueva Union, again, second Newmont, this is a premium asset for them. They've been mentioning it regularly as a part of their pipeline. We expect that, that's going to be probably in the production pipeline by the middle of the decade as Teck finishes up their Quebrada Blanca mine in Chile. The Dumont project in Quebec, that's the world's second largest nickel reserve. It's fully permitted in Quebec. Really, when you look at what's happening in the nickel side, North America is going to need its own battery supply chain. And, there's really no other project like Dumont, which has the size and the permitting combination and the location. I mean, it's really just, I think, ideally situated for everything that's happening now. So we expect that this will be the core, the next, of the auto supply chain here, which will go up in Quebec and Ontario, which looks like a key place. The United States seems to be very heavily pointing toward Canada as a place where they can source raw materials and kind of the overall battery side of things. Then Twin Metals, again, as I mentioned before, this is by far the largest copper nickel camp in the United States. There's been some permanent controversy around it, so I think it's going to take some time before the U.S. makes up its mind on how it wants to source its domestic materials. But I do think that given the prominence of the camp, which again accounts for 34% of all U.S. copper and 95% of all U.S. nickel reserves, that at some point this has to come into serious consideration. And then the Vizcachitas project over in Chile, as I mentioned before, again, also one of the largest copper development projects out there currently, undergoing a pre-feasibility study. They expect to commence shortly, and so we think that this will be in the hands of a major miner by the middle of the decade. I mean, all of these projects really are in position to be among the very first projects that will be required to fulfill the needs of the energy transition. That was the big attraction for us to acquire them, because we didn't want to buy things that were completely too far away. And we felt that these really represented a great collection of assets. And the one thing to understand about base metals, and is that there's a finite number of really top-notch mines. And so if you want to be a royalty company that really has a presence in the sector, you really need to be first, third, or fourth, second, if you want to have a real chance to kind of build critical mass. So we're very happy to have done this when we did, and we're excited for the future. A little bit here, sometimes we do buy exploration royalties, and that's, here we bought one on a Janet Lake project in Canada, which is around Rio Tinto, a major miner. Again, this is not a big point of emphasis for us, but once in a while when we do see these opportunities that could become major mines, we do buy the royalties. And that's a product of just the work we've done with the team, because we are focused on all the key belts, whether it's Canada, whether it's Chile, whether it's Peru, whether it's Argentina, whether it's United States, Mexico, et cetera. We have a team that's locally positioned, constantly going over opportunities, and sometimes these things do pop up. Again, here when you look at kind of how we buy things really from, at this point, the existing royalty holders who are often sitting on assets that, while very high quality and have very long life, are not yet generating cash. And really, given the fact that NOVR as a public company is clearly supported by the investor community to do this, we think we're very much the natural buyer of these royalties. And so, all the work we've done really on sourcing opportunities so far has really been to identify the royalty holders and have that own royalties and assets that we want. And really, the dialogue has been going on for a couple of years now. So we really do feel that whatever happens in the sector, we're going to have a front row seat to any transactions. And so we're pretty excited about that. And again, look, just kind of, I guess, a summary about the company. We've all been here from the very beginning. I think it was pretty clear to all of us when we started that the opportunity was really, really exceptional. And so it's great kind of to travel the route with the same guys. And, I think we're in a great spot to really capitalize on what's happening. And so, we're excited kind of to move forward. It's always great to meet new investors, kind of people who want to know more about the story. And I'll end it here and take any questions. Apologize, I'm just trying to find the questions here. Where can we see the here we go. Okay, apologies for that. Are you planning on acquiring further royalties, or are you looking into other metals as well? We are focused on copper and nickel because we think that the macroeconomics are by far the best. We look at all of them: lithium, cobalt, graphite, etc. I think when it comes to supply constraints on really high value-added deposits, there's really nothing like copper and nickel. Lithium, graphite, cobalt, they're actually, most of the value and supply chain there sits on the processing side rather than the mining side. So we haven't really been that excited about them. And also it's market size. I mean, lithium is what, a $4 billion market a year? Copper is 200 and growing. So there's really not much comparison, to be honest. But we're always looking to find new opportunities, no question. And so that's where we spend most of our time. So I think that, investors can definitely expect us to stay pretty active here, because what we're really trying to do is create the best way to invest in the commodities, period. So you always want to grow and add new strong properties. Where can we see company financial statements? On our website, you will see our prior financials, which will have our year-end financials filed by the end of April. So just check the website and CDR, and those should be out there. How does a royalty company flow returns to shareholders? Well, there's two ways. Number one, I think right now we're very much in the growth phase, and so we're adding properties. We're not yet cash flowing. As we begin to cash flow, we absolutely will be paying a sustainable dividend, and I think those dividends will flow for decades to come. So I think that'll be very exciting. Now and then, really, as an investor, you'll have the perfect exposure to the commodity because you'll have current income at some point. You're going to have a real duration to that income. And plus, you'll have the inherent growth in those projects, because when you look at the size of these copper nickel mines, they're enormous. So they expand consistently over time. So it's not uncommon to have a mine plan start in the 30-year range, and then the mine will go for 100 years plus, and at higher production rates that were initial. So you really get an exponential, I think, upside, kind of when you buy these things at the right price in the cycle. And I think we're buying them still very early days, given that the energy transition has barely begun. How tough is it to acquire assets in a reasonable price range, and what will be the valuation range? Excellent question. I mean, look, I think valuation it really comes down to, do you see the asset as a quality asset that has a place in the producer pipelines? I think that's really your first focus. If that's the case, you usually have some flexibility. I mean, if you look at what we've done so far, we've locked in double-digit IRRs on every deal, and those IRRs go out, 30, 40, 50 years. And so on a net asset value basis, we've bought them a pretty significant discount. So I think because we are the natural buyer for a lot of these assets, because sometimes when they're not cash flowing yet, and people want liquidity, then us being able to provide some combination of cash and shares to people is really attractive. I mean, when you look at it with the Taka, we bought that in two pieces. The first piece was 80% cash, 20% shares, and the shares performed very well. And then when we bought the second piece, they preferred to take 80% in shares versus 20% in cash. So I think the royalty owners are really beginning to see the value of kind of joining the NOVA register and getting the upside that way, because you get so much more diversification and commodity price exposure and asset exposure that you could ever get as a private owner. Let's see. I work as a royalty company. Do you have an active or passive role in management of the projects you invest in? No, we don't have an active role. We don't want to have an active role. I think you have to show some respect for the management teams that are running these things, and it's really very difficult. So, we prefer to buy royalties on top-notch projects, and kind of I think that's why you do it, because the teams and the companies are so strong. I mean, really, when you look at the copper nickel spaces, they're so capital intensive that you really need very strong companies with a lot of expertise and backing to get them done properly. So that's why we don't invest in the vast majority of things out there. But once we invest, we have a lot of confidence, obviously, in the people that are in charge of the companies. Do you see numerous opportunities for you to deploy more funds? Have other companies begun to see the world as you have? Look, we see a great deal of opportunity as a first mover. We mapped it all out up front. So absolutely, we see a great opportunity here for a long time, because I think the royalty model is so attractive in general. It's really, I think, the best way to get exposure to the commodity. So this is a sector that's going to enjoy a great deal of growth. So absolutely, we think there's a long way to go. I mean, this is literally, I think, the world's most important commodity going forwards, and nothing has really happened yet in terms of really momentous changes. At this point, people are still just talking about this. And then there's another question. Are there many more copper nickel asset holders that have royalties to sell? Yes, there's still a fair bit left, but again, it really depends on the duration that you want to take on. For instance, we focus really on the near-term stuff first. So there's obviously some more left over there. We haven't taken out all of them, but if you want to build a critical mass and foundation and diversify yourself, it's not as many as you would think. So we see a great deal of opportunity, but I think that's also in part because we have a great foundation that allows us to be patient. You don't want to rush into these things and wind up overpaying. I mean, we're seeing already some deals go down, which we just couldn't justify for our shareholders. But no, look, there's definitely a great deal of opportunity, and I think people will embrace the royalty model even more as time goes on. And then there's a question, what do we know about the potential for other metals to potentially displace copper and/or nickel? We haven't yet seen anything that could potentially displace copper. It's really the most widely used commodity out there, and kind of a lot of sectors depend on it. Copper doesn't depend on anything. It's the most conductive. Its applications are easily understood. Production can be scaled. I don't see how copper gets moved here at all. Nickel is a bit different. It very much is dependent on the automotive space. But when you look at the nickel properties and the fact that it's really the nickel batteries that are used for the higher performance batteries in cars, right now there's really no clear visible alternative in sight. On the lower end cars, the lithium iron batteries, lithium iron phosphate batteries have been successful to a degree. but I don't think that's a danger to the nickel batteries on the higher performance end. And I think it's very difficult to see where nickel doesn't play a huge role in the automotive battery market going forward. And here's a question. I'll probably take the last one. What percentage of the royalty arrangements are now producing, and when will most of them start production? So the real opportunity in this sector, because it's relatively new, was to buy royalties on the most important, systemically important projects before they're producing. Because if you wanted to get those royalties once it's producing, it's pretty much impossible, or the prices will be absolutely uneconomic. So that's really been the focus of the company, and really most of our projects, I think, are expected to come into production really in this first leg of the energy transition, and production dates will be somewhere between 2025 and 2030, which, given the development timeframes in this sector, is about as quick as you can expect. So over time, we expect to have a portfolio that cash flows pretty significantly, and but you want to start with the most value-added pieces first, and that's what we've done. What is the best way to invest from the USA? I think there's two ways really. One, you can buy you can buy the shares on the over-the-counter market, which so we have the OTCQB listing, which I think will allow you to buy it as a U.S. investor. Or separately, if your brokerage account allows you to buy on the Canadian Venture Exchange, you can buy our shares there. I think a very significant portion, I think, already of our investors are U.S. retail investors. So you should be able to buy either the OTC shares or the TSX Venture shares one way or the other. I think we're now out of time. I apologize for that. I would love to answer questions for longer. But we have a website with all of the contact information and the like, and so we'd love to hear from anyone if they want to know more about the company.
In the latest one, so we had to update that. We actively engage with government, and that includes the Critical Minerals Facilitation Office, which is based in Canberra. I was actually there last week and caught up with them last week, as well as quite a few ministers. We've got secure tenement legislation, an environmental approvals framework, and we've obviously got the established trade, export, logistics network and supporting the economy. So what you can see on the map there, we've got the major project is Browns Range. That's where we've got all of our resources and currently a pilot plant sitting there. But we've also got two exploration projects called John Galt to the northwest and Boulder Ridge just down to the southeast. In relation to our aspiration, we want to become the principal supplier of ethically produced rare earth separated products from a world-class heavy rare earth element inventory. And that's our differential when we look at it globally, is most of the companies that you would hear as being rare earth companies are light rare earth companies, and they rely on neodymium and praseodymium. Northern is one of the very, very few companies globally that have dysprosium and terbium in relation to going into the permanent magnets. We've been on an 11-year journey, as you can see here. We've spent over $272 million. So this is not a project that has been sitting there, hasn't spent any money or hasn't had any learnings over a journey. So, we had our initial discovery in 2010 with obviously exploration in 11, 12. And that's probably, at the end of 12 was probably the last time we've done any major type of exploration. And we were lucky to be able to get a resource back then, to get through to be able to do a DFS in 2015 for a full-scale plant. which we realised was going to be difficult to finance. So we had a new plan where we built a pilot plant at site for $70 million in 2018, and we've been doing test work on that ever since. You know, and along that journey, you know, we've had a lot of people work up at site and in our office. We've got to continue. Our COO has been in the office for nearly 9 years now. I've been there just over 8 years. You know, and you know, we've got an exploration senior exploration guy who's been there 10 years. So, you know, we've got a lot of continuous knowledge that that we maintain within the company. You know, our focus for 2021, we had a bit of a change where we're looking at doing a feasibility study just for a full-scale beneficiation plant. What you can see in the picture there on the right in the pilot plant is both the beneficiation and the hydromet plant we have at site. We've realised from some of the test work we've been doing that we won't build a hydromet at site in the future in relation to a full scale. That will be closer to a population base, cheaper power, cheaper sources of reagents, etc. We're going to do an accelerated exploration program so that we can increase our resource base. Currently, we're just waiting for a power train to get in relation to the ore sorter, for that to be implemented and start to be tested, and we're looking at commissioning that through late April, early May. We're going to continue testing through the pilot plant for the economic and technical viability of the pilot plant. And we're going to continue to investigate options for further separation. So in relation to heavy rare earths, you know, what we do at Browns Range, you can see at the bottom there, is very ethical. You know, we follow all the standards in Australia in relation to mining and environment. And what we're competing against is what you see up the top there, which is done in China. China produce 98% of heavy rare earths. So that's where most, you know, if someone like an Apple is telling you they're producing ethically produced products, that's where they're getting it for their iPhones and other things they're doing. So it's not really ethical. They just go down the supply chain a little bit to where they can actually say it's ethical. You know, what they do in China is they drill holes in the side of the hill there, pour acid into the ground and collect it in the sumps down the bottom, or collect 70% of it. 30% of it goes out into the environment. And they're mining basically 20 to 40 parts per million dysprosium through those ionic clays in southern China. What we have up at Browns Range in our hard rock through our resource is grades of 600 to 800 parts per million of Dy. So we obviously have much better grades, but we have to do the hard rock mining. As we said, you know, those mining methods that they do in China are, you know, are dirty and environmentally dangerous. So for those of you that aren't aware of the rare earth magnet supply chain, so we look at doing the mining and the beneficiation, followed by the hydromet, then separation, oxide to metal, alloy magnet manufacture, component manufacture, and then end use for the motor vehicles mainly. And, you know, China dominates in relation to this supply chain, and we know that. That's what we're trying to push past. What we do up at Browns Range is what you see in the light green at the moment in our pilot plant, where we do the mining, the beneficiation, and the hydromet. We've been doing a number of studies on separation, and we're going to continue to do those. And you know, in a long-term plan, we'd really love to go to metal making as well for our main products of dysprosium and terbium. We know, and we've heard a lot of talk in the media and through government, etc., about how the rare earth supply chain is critical. It's been called a critical mineral across the globe, whether you're talking in the US, whether you're talking in Australia, whether you're talking in Europe. And we know, especially for both the US and Australian governments, they both have a priority of trying to secure a rare earth supply chain outside of China. We know that's going to be difficult, and that's going to be timely. You can't just turn a switch to do it. But certainly we are well established in relation to being able to be one of those that will be able to produce, especially dysprosium and terbium outside of China. We've seen the executive orders come out from the new US President, Joe Biden, in relation to climate change measures, moving to zero-emission vehicles, which all go towards increasing demand of EVs. And, the former US President Trump had EOs as well in relation to the critical mineral supply emergency, and also talked about the US's undue reliance on China for multiple critical minerals. The US imports 80% of its rare earth elements direct from China, so that's why they see it as very important, and obviously most of you guys would understand that. And also the executive orders support the policies to try and build that critical mineral supply chain in the US, and particularly with strong allies, which obviously Australia is to the US. We're seeing a lot of government support. As I said, I was in Canberra last week for a few days, talking with our resources minister, as well as the Prime Minister's office and a few other people. The Prime Minister announced a $1.5 billion strategy in the federal budget last year to support Australian industry. This is the Modern Manufacturing Initiative to prioritise critical mineral processing and resources technology. The whole fund itself, he re-announced 2 weeks ago in relation to the first round beginning in relation to the funding, and we're obviously a big part of that. And within an hour of his speech, we got an email from Oz Industry to ask us to put our submission in, which we're currently doing and is due in by Thursday. So we've been putting a fair bit of work into that. So they're going to fund up to 50% of some eligible costs. So we're probably looking at somewhere between 3 and 6 million over the next 12 months or so from them. But the big thing for us is that the second stage of this is looking at funding infrastructure. So when we're looking at finishing our feasibility study this year and building a full-scale Benny plant next year, we can see that we're likely to get some federal government support to build that. It also renewed its support for the funding of the R&D. As most of you are aware, we were fighting with the ATO in relation to our R&D tax offsets, which we won in the second half of last year. And they were going to cap R&D offsets to 4 million, which they've changed their policy now, and there's no cap anymore. And there's also access for Northern to government support through the EFA, which is the Export Finance Agency, and NAIF, given the fact we're in Northern Australia. So that's the Northern Australia Infrastructure Facility. We know demand for electric vehicles is going to continue to grow. We've seen increasing demand everywhere. We know internal to China, prior to COVID, used to travel frequently to China, and, we could see them electrifying quickly. Used to go through car parking garages through China. Every second bay that they've got in there has a charging station. We know there's about 100 different motor vehicle manufacturers in China that are, that are all building electric vehicles that people wouldn't even know the names of. So, we expect this to lift over the next decade. We're seeing we're seeing countries around the world talk about no sales of petrol and diesel vehicles. And, you know, we saw the UK recently where they went from saying there'll be no sales of petrol and diesel vehicles by 2040. They brought that back down to 2035, and sort of late last year they brought that down to 2030. And 2030 is not that far away. So we're going to see EV sales and growth. It's going to be limited by access to these raw materials and finished commodities. That's the issue we're going to have in relation to looking at the graph on the left. You know, we've seen rare earths classified as critical minerals, but there are limited supply chains for heavy rare earths outside of China, and who, you know, obviously has a monopoly position at this stage. What we are at Browns Range is an advanced heavy rare earth project where we have the potential to fill some of that market gap and provide surety of supply for the rest of the world. So it's been interesting watching pricing recently. As you can see from the graph, you know, we had the spike in 2011 where, you know, China restricted rare earth exports as part of a dispute with Japan. That was more a geopolitical issue as to why prices went up and obviously came back down again in relation to dysprosium in particular, back to a fairly steady level of about $250 a kilo US for 8 or 9 years. We've just seen the spike sort of start to go up from sort of around the end of October last year, where it's you know, where it's gone up and hit nearly $470 a kilo, which is, you know, up over 83% from the end of October. You know, we certainly see these as the start of new norms. We don't see this as what happened in 2011. For the fact that this is based on demand and supply driven for EVs rather than just geopolitical issues. Same things happened for terbium. Obviously, they had the same spike back in 2011. They've been a bit more up and down over the years, but terbium has certainly spiked up significantly from the start of 2020, where it's up 173%. You know, it was around the $500 a kilo, now sitting at $1,470 a kilo. That obviously, what all that means for us is for our basket price is that, you know, it means we've got a great basket price in relation to looking at our feasibility study moving forward. And these are prices that we thought we'd be seeing sort of 5 or 6 years ago. So this is not something that we didn't think was going to happen. It was just a matter of when. This was a good story for any of you who want to actually get an understanding of the rare metals war that we're talking about happening with China. This was a great book done by a French investigative journalist. The interesting story was we got sent a book to our office. Didn't know where it came from. I know I rang George, our old MD, and said to him, did he send it through to us? And he promised me he hadn't. It was something that he was likely to have done. But we ended up finding out that I tracked down the author. I got hold of him through LinkedIn, and we've had a few chats since. But yeah, he's won some multiple awards with this book in France. He's been in China, and this goes through not just rare earths, but different other metals as well, and talks about how China is very unenvironmentally friendly in how they do it, but what a great job they've done in relation to the whole downstream processing, and how the rest of the world's got a long way to go to try and catch up. So I'd recommend that to anyone if you want to have a listen. Oh, sorry, have a read. So we're continuous improvement up on site with the ore sorter. As I mentioned, we're looking at trying to commission it late April, early May. We're going to do the trials of some of our ore that's sitting at the front of the pilot plants. We've got all the approvals, etc., for the ore sorter, and we'll get that moving as soon as we can, as soon as we get the power station down there, which is hopefully going to be in the next week or so. So we're moving towards doing a commercial scale DFS, as we talked about, for the beneficiation plant. One of the beauties of having built the pilot plant up on site and having a concentrate that goes into the hydromet plant is that we've now seen some market opportunities for our beneficiated product. We've had people come out of Australia, as well as the US, as well as Southern Asia, say they're interested in offtake for the concentrate, which just comes out of the beneficiation plant. We see this as a much lower risk approach in just building a full-scale Benny plant. It's obviously going to be cheaper as well. And it also looks at giving us cash flow in 2023, which is 2 years earlier than if we were going to look at doing a full-scale plant with hydromet and separation. And it'll be much easier to be able to finance the Benny plant versus a standalone project. Our exploration, we're going to continue to ramp that up. We had an announcement last year where we had an 8,500 metre drilling program, which we completed in the end of 2020 before the start of the wet season. Got a further 8,000 metres to be drilled. That could be more. We've just been talking to our exploration manager today, saying, let's get some more done if we can. We're just waiting to do some native title clearances so that we can get into some of the more highly prospective places that we want to actually go and drill. We had some encouraging results from our first pass of drilling in 2020, and we've got some new greenfields targets that we're looking at drill testing for 2021, as well as looking to do some deeper holes at Wolverine to test the resource as it's open along strike and at depth. As you can see there, in relation to our blue sky, on the left is WA side. The black line is the border between WA and NT. We haven't done any exploration work on the NT, but as you can see, the dome extends through the Northern Territory, and we have the licenses for rare earths over that whole dome, and that dome extends 60 kilometres by 30 kilometres, so it's a huge area. And that's all of our blue sky. Our exploration manager's very keen to get into the NT. Got about 170 targets that he wants to go through. So we're looking forward to doing that, and that will be some of the focus of our exploration work. I mean, we want to increase our mineral resource so that we can get, 20 plus years in relation to our DFS. We've got more than 2,300 square kilometres of tenure. So, it's phenomenal, the blue sky we've got there. We had a recent capital raise, which was done by EAS Advisors from New York, and we raised $20 million, which was oversubscribed, but we just took in the 20. The majority of the money went to US and Australian sophisticated institutional investors, and the funds are going to be used for us in our work program that I've gone through in relation to 21-22, including the feasibility study, and also obviously the uplift in exploration. So we're fully funded to get to a board decision for a go, no-go in relation to a full-scale beneficiation plant next year. And obviously, if there's a positive board decision, the next major funding for us will be looking for the build of a full-scale beneficiation plant. So corporately, I know the US doesn't like it, but we've got nearly 5 billion shares out there, just over $200 million market cap. But the big thing is we've got $25 million in the bank. We've got no debt. So we're in a fantastic position in relation to, to where we want to be. We haven't been in this position for the whole 8 years that I've been here at Northern, so great that we can be here. Obviously, all the shareholders are there on the left-hand side as well. And our share price, obviously, we'd like to see our share price doing better, but we see that as coming with keeping hitting our targets in the market. So our potential, for us, we're going to be the only significant producer of heavy rare earths outside of China, and we have been over the last 2 years as well. We've got a lot of IP in relation to production of rare earth carbonate from site. We've got a commitment in relation to exploration and building our resource inventory. We're obviously fast-tracking the feasibility for a full-scale beneficiation operation. As I mentioned, we've got a strong balance sheet, no debt. We're in a great jurisdiction in WA, and obviously US and Australian governments acting on supply chain threats for heavy rare earths. So that's why you should invest in Northern. Thank you very much for listening. I will start looking through some of these questions. Sorry, I haven't gone through them. So, question here is: are you seeing any government support for securing critical mineral chains? Yes. The answer is there's a lot of support in relation to verbal support. What we really need to see is actions coming through from the government, and the first part of that is what I talked about in relation to this grant that we could potentially get over the next month or so. So we'll see how that goes. Another one is: do we see NTU as relying upon ThyssenKrupp long term as your sales agent, or do you envisage doing that by yourself eventually? Look, we have an offtake agreement with ThyssenKrupp in relation to our pilot plant production, as well as a part of our full-scale production. So that's just something we will look at as we move down the track. But certainly, in relation to sales of concentrate, we're getting a lot of interested parties and good parties in relation to who wants to look at purchasing our concentrate. What are your plans to list in the US? We've got a plan in relation to looking at listing on the OTC in the coming months. So just watch this space. But yes, we certainly do. I know we've been talking about it for a while, but we're certainly a lot closer to looking at doing that. I'll guarantee you we'll have it done before the end of the year, but hopefully a lot sooner than that. Another question: what do we see as proper long-term price for DY, particularly given what's happening now in Myanmar? Look, it's an interesting one. I know when we've talked to Jack Lifton, etc., and when you think about it, for us, there's about 100 grams of DY that's used in an electric vehicle. So when you're talking about $470 a kilo, so you're talking $47 in the value of an electric vehicle. So where can it go to? We've and I think Jack's talked about this before. Somewhere the $750, $800 US, is not going to let motor vehicle manufacturers flinch in relation to electric vehicles. So I certainly see it heading north of 500, and hopefully hitting somewhere along the 700 to 800. What is your proposed capacity on a TREO basis and timeline? Look, we're looking at producing a concentrate potentially, and again, these are very early days. So looking at around the 4,000 tonne of TREO. which would include roughly 400 tonnes of DY in relation to a full-scale beneficiation plant. But again, we're just going through all of that process for the feasibility study, and that's just a real rough number.
Colleague Christopher Ecclestone calls a parable. I don't know why, but let's say that, and I'm going to make you remember this by calling it the KKR story. I don't mean anything to do with Henry Kravitz. What I mean is Bill Knudsen, Henry J. Kaiser, and Franklin D. Roosevelt. In 1942, very early on, President Roosevelt was faced with a problem. We were at war, and we didn't make any tanks, ships, planes. You know, we made a few, but nothing that we needed. So he brought in the industry leaders, the manufacturing engineer managers who were outstanding. Bill Knudsen, then the president of General Motors, and Henry J. Kaiser, the president of the Kaiser Group. And he said to them, I need lots of planes and ships, and somebody's got to design and build us a tank and machine guns and cannon. We had small arsenals in those days that did that. These were businessmen. They were certainly not academics. They were not bureaucrats. They were hands-on people. Guess what happened? Within a year or two, production was ramped up fantastically. By the end of the war, a bomber was coming off the Willow Run assembly line. That was Henry Ford's contribution every minute, and a Liberty ship was launched every few hours. There was no way any of the opponents of the United States in that war could possibly win against our economic and productive capacity strengths. The war was over before it started. Now, fast forward to 2021. We have our government is being looked upon as the savior of our country's needs for so-called critical materials. Okay, it is not. The government, as Ronald Reagan said, gets in the way. What we need here is an appeal to our industrial base and to restoration of the productive capacity we once had. Now, so the question here, can critical material supply chains be economically constructed in the free world, is really a misnomer. The question is, can critical metals value chains be economically constructed in the free world? Now, I don't mean to be pedantic, but I think we all need to take a look at basic economics, because as I'd like to say, as I switch slides, the answer to this question, if you're talking about the free market that we supposedly have, is if and only if the cost of goods sold at the point in the supply chain where the company we're talking about, whatever it is, enters the market, i.e. sells its product, to the next step in the supply chain, only if that cost is less than the selling price at that time. So the investor and the first-year economics student in university must ask, what will be the cost of goods sold on the day your products are offered into the market? Please don't tell me about the price today or the market basket price value of your material. I just want to know, what are you going to sell, when, and can you estimate, guess, what will be the price you'll sell at that day, and what will be your margin? And when will you, if your margins are positive, when will you reach a target production? Okay. And finally, I understand that in the beginning, it's all proof of concept. It really is. In any mine, you have to make sure that process you've chosen to concentrate your ore works. And then will economies of scale or process improvements at your point in the supply chain, not downstream, allow you to remain competitive if selling prices should decline? And we never know. They will. Okay. So for the purposes of this discussion, I'm gonna look at just the critical metals involved in producing energy by alternate to burning fossil fuels means, and illustrate my point. And the question I'm going to ask all of you is, what do the production of end user forms, I'm talking about the final step in the supply chain prior to the production of consumer or military use devices, what do they have in common? Okay, one thing is copper. Every electrical and electronic device on this planet must utilize copper to distribute any currents that are not trivial. Uranium. All nuclear electric production today in the world is based on uranium. Cadmium, nickel, tellurium, selenium, all necessary for solar cells. Lithium, cobalt, manganese. Those are the high energy density lithium ion batteries. The rare earths, they provide the strongest permanent magnets for motors and generators, and the smallest. They are absolutely important for consumer devices, because if any of you are old enough, and I doubt it, to remember the original washing machines before rare earth permanent magnets, they were incredibly clunky, because that magnetic motor, it is AC motor, was much larger than the modern rare earth permanent magnet motor. Vanadium and magnesium are used for so-called redox and molten metal batteries. And so all of these metals have one thing in common. The only thing they have in common, they're critical. And copper is not particularly rare, but the production each year in the world is maybe today 30 million tons. And I suspect that production level could be maintained for some time, not forever. We've been high grading copper mines for at least 130 years. So there won't always be that kind of tonnage of copper. Don't believe people who tell you, oh, we'll be increasing the production, if we have to. No, it's if you can, not if you want to. Okay. Let's talk about the critical metals involved in producing energy. Let's focus on that. The question here should be, which of them are all found in accessible, economically mineable deposits in one country? What I mean is, which group of them? The answer is none. Does any one developed country have sufficient quantities of all of them for its own needs? Now, by needs, I mean consumer needs. No. Are the mining techniques the same for all of them? No. Are the refining and metal alloy manufacturing techniques the same for any two of them, with the exception of some of the rare earths? The answer is no. This, I hate to say it, critically important to understand. These metals are mined in different ways, they're refined in different ways, and they're processed to end user products in different ways, very different ways. So much so that each one of them has an industrial supply chain and value chain. Now, let's ask if got to get my copy here, if we can talk about commercial scale chemical engineering. Now, why did I bring this up? Because I don't think that the tone here today is really correct. I don't think the United States is in competition with the Chinese as much as we have to look at what the Chinese are thinking, not just us. If you want to make a list of critical metals, it's very easy. You just look at what the Chinese have prioritized, because they have total supply chains and more importantly, total value chains in their country. Give you an example. China mines, as far as I know, almost no cobalt. Yet 80% of the world's cobalt processing is in China. And that means capacity. And the Chinese produce end user products for the alloy industry, for the catalyst industry, and of course for the battery industry. Now, to say that we don't talk about, well, should the United States produce enough cobalt for its own use? For one thing, if we make any lithium-ion batteries in the United States today, they're entirely made from components sourced from Asia, Korea, Japan, and China. We don't. There's a tiny bit of manufacturing of the components cells of lithium-ion batteries. I think at Panasonic, Tesla, of course, in Nevada, and General Motors has announced they're going to make batteries, and Ford has announced that, and I know that Hyundai is looking at all of the companies that assemble cars in the United States that want to sell electric cars in the United States are talking about going into the battery business. But none of them seem to be paying any attention to the fact they cannot get the materials which immediately are made into batteries in the United States. We certainly don't have any significant lithium production. We have, as far as I know, just a tiny amount of cobalt production as a byproduct of some nickel mining in Michigan. And we're not mining manganese now because it's cheaper to buy it overseas, because the high grades of manganese we had at the beginning of the 20th century are gone. And there's as I said, very little nickel mining in the United States, I'm talking about. And what there is currently in Michigan, and there is a little bit of cobalt coming out of that. I'm focusing on the United States here because I hear a lot about how we're going to have a North American supply and a domestic supply. I'm not sure which is which. And I hear a lot about the Australians are going to be financed by the U.S. to produce materials for the U.S. market. And I don't believe any of that. I used to say that the ABC powers in mining were Australia, Britain, and Canada. Australia and Canada are major producers in the non-Chinese world, and Britain is really where mining finance originated. I still believe that, and I think that you're going to see Canada most likely be a supplier to Europe rather than the United States. Why? Europe already has the value chain in place for many of these materials. Let's talk about rare earths. Europe has a metal making company, rare earth metals and alloys, and it has several magnet making companies who still make rare earth permanent magnets from neodymium iron boron, which we no longer do in the United States at this point. Now, Canada has been talking to Europe about licensing the technologies for metal and alloy making and even magnet making in Canada, or getting the European suppliers to open up in Canada, or in the alternative, becoming part of the value chain with a larger European entity. I hate to break the news to everybody here, but the mining of, for example, rare earths is not where the profit is made in the rare earths value chain. Neither is the separation of the rare earths into individual rare earths. The value add, the big value add, is in magnets, metals, alloys, and magnets, and of course, the end-use components. The point is, we only have one company outside of China that has all of the components of the supply and value chains except mining. Now, many years ago, I met the then president of that company at a conference we were both speaking, and I said to him, "Why aren't you totally vertically integrated?" And his answer was, why should I subject my company to the variability of pricing in the mining space? He said, that could kill my profit margins or require so much distribution of margins along the value chain that my company wouldn't be profitable anyway. He said, so I prefer to be a service company. I get materials consigned to me by a client or bought on my behalf by a client, and I go from there. Okay, that was 14 years ago. It's still true. It's still true. The mining is not the place by itself to look at. What you need to do is find the sweet spot in a value chain, and mining, of course, is critical. You have to have it, but if you can get a profitable mining operation in your supply chain, you're bound to make money in any of these critical materials. Now, that's where I disagree with my colleague about China. I think China's main concern is its internal markets, its domestic markets. The current buzzwords in China are they want to create by 2025 a market of two circulations. One circulation is the domestic consumer economy, a la the West. The other one is the export economy, which is currently the larger of the two economies. They want to do away with this dependency on export because they want to advance their consumer economy. Now, does that sound like it's a competition for world dominance or power? No. China is run by technocrats. They enable the policies created by the Chinese equivalent of the Politburo, the so-called, what the heck is it? The State Council, okay, which is just the old Soviet Politburo. And these fellows come up with policies, and the technocrats of the government carry out the policies. They don't talk about them. They don't have meetings about them. They carry them out, and they deal directly with the industrial and productive capacity of China. The United States does not do this. We did it in World War II because the president just cut through all of the red tape and went directly to industry. When I see the United States national government call in industry to ask how to solve the supply chain and value chain problems, I'll think we're on the right path. Until then, I don't see it. I really don't. Our government has become a political theater, and what's going on in our government is that they have decided that there are winners and losers based on irrational categories. So they can't call in the miners to Washington because, of course, mining is evil. They've already said that. So they just ignore the fact that mining is the source of all of the so-called critical materials. And of course, China has long ago gone global on sourcing raw materials. They saw this as a need 20 years ago. Today, as Christopher Ecclestone pointed out, they're importing half of their needs for so-called heavy rare earths from Myanmar, which Christopher, being a British subject, calls Burma. And that's interesting, isn't it? Because the Chinese were the world's only supplier of heavy rare earths up till about 4 or 5 years ago. Now they say they get half their needs from Burma. Their largest supplier of raw material, remember raw material, is MP Materials, whose mine is at Mountain Pass, California. And they're also buying, that mine produces the mineral bastnasite, which is about 13 to 16% NdPr, but they're buying also very large quantities of monazite around the world, and monazite is up to 22 and 24% NdPr, the important magnet metals. Plus, monazite has the heavy rare earths, dysprosium and terbium, as the associated mineral xenotime. And of course, bastnasite has no rare earths beyond samarium, europium, and gadolinium in tiny quantities. So monazite is the preferred mineral, no question. The problem has always been that monazite is naturally radioactive. It contains thorium and uranium. So in any Western country, getting a license to process something like that is extremely difficult and unlikely. Certainly, institutional investors don't want to bet on something like that. The Chinese had the same constrictions, but they solved the problem by getting China Nuclear Corporation involved. All the monazite they buy goes to China Nuclear, which removes uranium and thorium and then passes it on to the Chinese buyer. In the United States, we have exactly one licensed place where monazite can be processed. That is White Mesa, Utah, the uranium mill of Energy Fuels. Energy Fuels saw this opportunity and has already begun to do that. Now, this is not something you can do in Europe. I don't know of any European country that would allow a radiation-laden ore to be processed in this country, because what do you do with the radioactive metals once you separate them? And this is not something that most countries like to have in the hands of private industry. So the problems, that's a major problem, the radioactivity, but using monazite has now become really important in China. China Nuclear is licensed to handle 50,000 tons a year of monazite, which if the monazite were the typical 50 to 60%, is 30,000 tons of total rare earths. That's a lot of material. And we have just begun to look at this. We have the one company pioneering this in the United States. I doubt another company could ever be licensed in my lifetime. I'm an old guy, so it could be your lifetime to do this. Now, I'm gonna stop babbling here and just say one more thing. If you're going to invest in anything to do with critical metals, look at the economics of the total supply chain and the value chain. Make sure that there's a place, if whatever company you're investing in, make sure there's a home for its products, that its products can actually be utilized by the next step in the supply chain. Don't you believe that a greenfield site in Nebraska is a super alloy mine? That's silly. Neither should you believe, without evidence, that anybody is a mine-to-magnet operation. I'm just as an aside, I'll tell you, making rare earth permanent magnets is as much an art as a science. But if somebody says they're mine-to-metal, that's something you can pay attention to, because that is certainly doable. By the way, I'm not knocking mine-to-magnet if there's a magnet maker involved in the supply and value chains. Okay, we have a problem in the United States, and I'm going to sum it up in I hope one sentence. That sentence is, they say that Washington is Hollywood for ugly people. I think it's more true that Washington is MIT for dumb people. I don't think that the politicians in Washington have any idea of what a manufacturing supply chain or value chain entails. The military can subsidize, and it is subsidizing, trying to get the materials it needs. But those amounts of materials are tiny compared to the consumer demand. And I don't see the United States government subsidizing consumer demand. And so I think everybody's got to sit back and take a hard look at these critical metals and see just what is doable and what isn't. I don't think the Chinese controlling these flows makes much of a difference at this point. I don't think the Chinese are going to cut anybody off until their domestic market is large enough so that they don't have anything to export. But what they are going to be, and growing even more so, is a competitor for critical raw materials in this world. This is what we've got to look out for. We've got to go out and get the raw materials we need while we build the value chains in the United States to process what we need. Thank you. Now, I see that I've got a question. Will the U.S. industrial complex create the value chain as they did in World War II? No, I don't think so, at least with the government we've got, because in World War II, they were working on cost plus. Yeah, they were concerned about cost, no doubt about it, but it was cost plus they had. Nobody said, well, I can't do something because it's too expensive. They did say that, and then the government would say, okay, go ahead. What's the price? Go ahead and do it. They did that quite often. Another question. Do you believe the current administration has a plan in place to address the Chinese dominance of these critical metals? What can be done to lower our dependence on a near-term basis? Well, the answer is, I don't think our government has any plan. They like to talk about things, not do things. But I think that the only way we can get the job done is to form an industrial association, so to speak, with Australia, Canada, and Europe. Australia and Canada produce raw materials that we really need, and some that we don't have. But between them, they supply all of the critical metals that we need. The Europeans have in place the value chain we lack. And rather than reinvent the wheel, I think we might want to do something with them. There's a chance that there'll be, Australia, Britain, Canada, the United States. We could all get together. We could solve all of, at least for our military, solve all the critical materials problems. But it can't be. I don't think it can be done in just one country. Question: are there plans in the U.S. to support the critical materials value chain? Not to my knowledge. I'd love to hear from somebody if there is. We don't have anything that I'm aware of. Oh. Okay. Thank you very much. I hope I haven't made any enemies, and I hope that all of you will compare what I'm saying and what Christopher Ecclestone is saying and form your own opinion. That's the way it should be. Thank you.
Questions in the question box to the bottom left of the slides. Once the Q&A session is ended, don't log out. You will automatically be transferred into the Energy Fuels booth, where you can continue to ask questions via chat and access additional shareholder materials. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I am very pleased to welcome Mark Chalmers, President and CEO of Energy Fuels Inc., which trades on the New York Stock Exchange American Exchange under the symbol UUUU, and on the TSX under the symbol EFR. Welcome, Mark.
Thank you, Matt. Thank you for the introduction, and thank you for those that are listening to the presentation today on Energy Fuels, America's leading producer of critical minerals. I may be making some forward-looking statements. Those are included at the back of the presentation on pages 23 through 25. Let's start off by just talking about the core business case of Energy Fuels. We are the U.S. leading producer of critical materials, and first and foremost, our core business is uranium. We are the largest U.S. producer of uranium in the United States. We are currently starting up rare earth element production in the United States, and we're very excited about that, and I'll talk more during the presentation. We also have the only primary vanadium plant in the United States, and we're the largest primary producer of vanadium in 2019, and we have a long-established recycling program where we've recycled substantial amounts of uranium and vanadium over the last couple decades. We also have significant financial strength and zero debt. We have cash, securities, or inventory in the order of around $80 million US, with substantial inventories of both uranium and vanadium. More on Energy Fuels, obviously. We have four legs to our stool. A lot of uranium only or rare earth only or vanadium only plays have one leg to the stool, and we have four legs and four very solid legs, and we're very proud of basically what we represent to investors because of those four legs, and we have a long history of production, and we are doers, and we operate at the highest global standards, and we provide numerous elements for clean energy and advanced technologies. We recently announced and released our sustainability report in December, which shows the many good things that our company does on all fronts, and we're very proud that we believe we do some of the largest contributions for a company our size when it comes to clean energy and reducing carbon emissions. Our footprint goes from Wyoming all the way down to Texas, so it's a lot of real estate. We have projects in 6 of the U.S. states. The stars, the 2 green stars, are our in situ recovery facilities. Those are uranium facilities that we can recover uranium. Both these sites are on standby currently. And then the blue star is the White Mesa Mill that is currently operating. That's in the Four Corners region of in Utah. And I think a lot of people lose track of the fact that the United States gets 20% of its electricity from nuclear power and 55% of its clean energy from nuclear power. So anyways, we have a substantial asset base, 3 fully licensed, fully paid for production centers. No one else in our kind of category has 3 production centers that are fully licensed and fully paid for. This is just a little bit more information on the 3 production centers and the Pinyon Plain mine that's in Arizona. The White Mesa Mill was constructed in 1980 and it's currently producing, and this is the site of our conventional uranium and vanadium mill and soon to be rare earth crack and leach facility starting to produce this week. And I'll talk more about that. The Alta Mesa project in Texas that I mentioned is on standby, and the